Hi, I'm Rick Kahler. Thanks for joining me. When Maria needed $400,000 for a down payment on a new home, her broker at a large Wall Street firm offered a solution. Don't sell the investments and trigger capital gains. Take out a margin loan. A margin loan is a line of credit. It's basically a loan from a brokerage firm that's secured against the client's investment portfolio. It can act as a quick access to cash with no immediate tax consequence and pretty minimal paperwork. The convenience, though, comes at a cost. As of mid-2025, margin loan interest rates ranged from 6.25% to over 11%. Margin loan recommendations are often presented by brokers as tax-savvy strategies that allow clients to access tax-free cash while keeping their portfolios intact. In a lot of cases, the math benefits the advisor and his firm or her firm more than the investor. When interest rates are compared to expected portfolio returns, the cost of borrowing often exceeds what an investor is likely to earn by holding on. Suppose, for example, that the interest rate on Maria's $400,000 margin loan was 7.5%. While borrowing delayed her having to pay, say, $20,000 in capital gains, she will eventually have to pay that tax anyway, except in the case that she held the investments until death and got what we call a stepped up in basis. So 2 years later, with portfolio returns of, say, 4% annually, she had earned around $32,000 from the $400,000 in investments she might have sold. But meanwhile, she had paid $60,000 in interest, leaving her some $28,000 worse off. And that's without factoring in ongoing interest rates payments that would accrue after, if she held over 2 years, or the risks of a margin call if the investments securing the loan dropped in value. The way margin loans work, you can borrow up to 50% of the total value of the securities. But if those securities go down, you've got to pay back enough of that margin loan to reduce it to 50%. So that's what a margin call is. So why do advisors keep recommending margin loans? Because selling investments reduces the portfolio size, which reduces the advisor's fee. Borrowing keeps the portfolio intact and the compensation unchanged, while the firm receives, along the way, added income from the investments or the interest rate on the loan. So for the advisor and the firm, it's a win-win. And in some cases, advisors suggest using margin loans to buy more investments, increasing both the portfolio and the fee they collect. Now, none of this is illegal. But when the borrowing cost is higher than the expected returns and the advisor benefits financially, the ethics can be questionable. The client takes the risk while the advisor keeps the revenue. This kind of conflict appears more often in portfolios where compensation is tied to asset value, and the company's primary culture rewards gathering assets over delivering unbiased advice. By contrast, fee-only financial planning and investment advisors typically operate on simpler hourly, flat, or tiered fee structures. Their compensation doesn't depend on whether a client borrows, sells, or holds. So the culture of the firm focuses on conflict-free advice aligned with the client's best interests. Wall Street brokers are often held to a fiduciary standard, but structure still matters. In 2024, the SEC reported their examinations of brokers would continue to focus on advisor recommendations unduly influenced by the company's compensation and incentives. There are rare situations where a margin loan may be appropriate, so don't get me wrong. A client with large unrealized gains might use a short-term margin loan to minimize taxes. Emphasis on short term. An elderly investor might borrow tax-free rather than sell assets that will receive a step-up in basis at their death. That could be smart planning. But even in those cases, the math must be exact, and the client must clearly understand the risks, including the possibility of a margin call. So if your advisor recommends a margin loan, especially to buy more investments, ask strong questions. What's the interest rate? What return is realistic? What are the tax consequences of selling? How does this affect the advisor's income? And if you don't get direct answers, that's probably a warning sign. In a high-rate, low-return environment, margin loans rarely favor the client. The exceptions are narrow, the risks are significant, and the conflict of interest is measurable. Sometimes the smartest move is the simplest. Sell what you need, pay the tax, and leave leverage out of your plan. Thanks for listening.